Okay, there we go. Hello and welcome to the Graduate Student Legal Aid GRadulting Workshop Series. My name is Debbie McCutsky, and I am the Coordinator of Services and Programs for Graduate Student Legal Aid. Our focus today is so fun. It's taxes for domestic students. So we've all got a little over 5 weeks before that April 15th deadline. That's the date when you have to file your federal and state income tax returns for 2024, unless, of course, you request an extension. I encourage you to start preparing your taxes now. Don't wait till the last minute, because if something comes up when you're filling out those forms and you've got questions, you may need a bit of time to do some research and get those questions answered. But we've got lots of help for you today and some resources to help you along the way. So before we start the presentation, I just want to make sure that you know a little bit about Grad Legal Aid. I may have met you, or you may have met another staff member at orientation, but I just want you to know that Legal Aid does more than these workshops. So we provide students to support, students who need legal consultations. If they've got a legal issue, say a problem with their landlord or a traffic ticket or an insurance issue. We do legal consultations for students who have immigration issues. We have advocates on our staff who help students who are facing university charges or Title IX issues. I am a notary public, so I can help you if you need something notarized. So if you paid your student fee, and I know you did, then you've already paid for our services. So there is no need for you to hesitate to come ask us for help. If we can't help you, it's likely that we know someone who can. So I encourage you to visit our website, learn more about our services, and you'll find instructions there on how to request an appointment. So now let's move on to the rules of engagement for today. This session is being recorded, and I will share the link to the recording and resources tomorrow. I will send an email to everyone who registered for this workshop. Please use the Q&A for your questions, not the chat, the Q&A. The speaker will answer questions, some of them during the presentation and others after the presentation. And so don't be shy about asking questions. You know, we're all here to learn and support each other through this tax season. So I am now pleased to move ahead and introduce our speaker. He is a very generous man who shares his time with us and students all across campus every year as we kick off tax season. Please help me welcome Professor Samuel Handwerger.
Oh boy,
Hey,
with that
Sam.
introduction, I'm probably just going to click off now and call it a day.
Let me say a little bit more about you. Professor Handwerger is a CPA and a lecturer at the University of Maryland's Robert H. Smith School of Business. He is also the faculty advisor for TerpTax. Sam's going to tell you more about TerpTax, but that's one of those places where you can go to get advice, support when you are filling out those forms and you don't know what to do. So Sam, please share your screen. I'm going to turn this session over to you.
All right, thank you very much. And I'm going to do that now. All right, thanks. Okay. Okie dokie. Let's see. Let me try this again. Host disabled participant screen sharing.
You are a co-host, so you should be able to share.
Okay. Here we go. Now it's working. Okay. Fun when it's not working 100% every time, right?
I think we're all used to Zoom and the glitches that go along with Zoom.
Yes, but thanks to COVID, we're a little too used to it.
Yeah. You
All
set.
right, well, okay, welcome everybody. We are doing filing taxes as a student, and the question mark in this particular case is making sure you're in the right lecture hall here today. We're going to be talking about students who are taxed as residents within the United States, and that means you are either a citizen born here, or you are here 183 days at least, so greater than 182 or 183 days over in 2024. That would be the requirement. Now, the test is a little more complicated than that. So if you are not a citizen or a green card holder, then so I'll put that in green. Green card holders are also residents. That qualifies. Citizens qualify. Or if you're none of these, then you may, and if you weren't here 183 days last year, it still doesn't mean you're not a resident for tax purposes. You want to check with me offline to determine whether you're still whether you might still be a resident for 2024. But the simple tests are for resident would be green card number one, citizen actually number two, or number one, and then 183 days in 2024. If any of these categories you meet, you're in the right place at the right time. And as I said, in the event that this one here doesn't follow you and you're not anything else on this page, then you want to check with me offline just to find out whether you still are or could be a resident in 2024. And it's important because all we're talking about today are people who qualify as residents. The other choice would be non-resident, and that's a totally different taxation formula and schematic. So hopefully we're all in the right place today. Okay. Moving forward then, assuming we're all residents, let's take a look at what happens with your tax questions and getting your tax return done. Not to be advertised too often today, but this is our website. You can make an appointment. We have lots of volunteers standing by. You can make an appointment to do in-person tax return. We'll help you do the whole thing. You can do your own return on it. There's an option to self-prepare using our software, and then we're available to answer questions. Or you can get an asynchronous appointment. And then after spring break, there'll be some walk-in clinics. Those will be advertised on our website as well when we have the dates all set up. Okay, so what is, the kiddie tax? Why am I starting with the kiddie tax? That's pretty interesting. You're not kids anymore. You're definitely not kids. Sometimes you may act like a kid, but you're definitely not kids. So why am I doing this? Because there is such a thing as a kiddie tax, which means certain types of your income can be taxed at a higher rate than you normally would have. And what I'm saying is, let's take a look at the formula of taxation so it'll all make sense, and then we'll come back. So the formula of taxation is you have to report your gross income from whatever source derived. And one lesson for that is WW income, which means worldwide income. So no matter where you work, no matter where you earn your money, in the United States, for residents, you report your worldwide income. So it's gross income basically from everywhere. Quick little examples, anecdotal story. It's a true story. You find $5,000 in a piano that you use piano, you buy this used piano, you bring it home, and in the piano bench, in addition to some music books, is $5,000. The seller left it there by accident. You keep it, let's say. It's yours. It's income. It's reportable income. Do people report it? I'm not answering that question based on the Fifth Amendment and the fact that I'm teaching business ethics next semester, but you get the idea. So you're really supposed to report all income unless it specifically says in the tax code it's exempt. So there are certain categories of income that are exempt, but they have to be labeled in the tax code, and there are not too many of those. Then the next thing that happens is you start looking at, okay, what type of income do I have? Because certain types of income will be taxed differently. Do I have earned income from a gig, like an Uber gig, or working as an independent contractor for an internship? Do I have earned income outside of the W-2? So the W-2 also is earned income, but we're not talking about that now. and that is subject to self-employment tax, which is Social Security, Medicare. As a W-2 person, you pay that, but the employer takes it out from you, so you don't have to worry about it on your tax return. It's already been paid. But if you're earning income outside of the W-2, independent contractor, you're going to be subject to self-employment tax. That's number one we're going to do. This is not the right order, but you'll get you get the message. So that's one type of tax. And this is all in our internal revenue code, all these different schemes of taxes. And then there's an income tax, which is the famous name you've heard. There's an income tax, and that's based on your level of income. So as your income goes up, your rate of tax goes up as well. That's what we call a progressive tax system. The rate goes up, the percentage rate goes up, and the last rate you get at. So the very last dollar that gets included in your tax return, so that whatever that last dollar goes in at will be taxed at the highest rate for that dollar on your tax return, for your tax return, for your tax bracket. These are what is known as tax brackets, and they vary based on levels of income. They go from like 10% all the way up to 37%. So it's 10% up to 37. For most of you, you will not be in the 37% bracket, so you don't need to worry about that. All right, so this is the basic formula up to this point, and then you get to take what we call deductions. Deductions lower what is eventually going to be subject to tax. So let's go back to the formula. Start the formula again so we can see it. Here we go. We report your income. Then you start taking what is deductible under the tax code, what you can reduce your income by. And for most of you, what will apply there is what we call the standard deduction. It's so high today that even trying to bother for other deductions usually don't make any sense. It's 14,600. So you can make 14,600 in earned income. This applies to earned income. You earn it, and then you got a standard deduction of 14,600, and you see you're left with zero taxable income subject to those tax rates that we talked about. So far we've covered the Social Security tax for self-employment earnings, gigs, internships, things like that. Now we've covered the income tax, and there's one more little tiny bit to go over, and that is dividends and capital gains. In case you're invested in a stock market or a mutual fund, you may be getting dividends or capital gains. If you're invested in cryptocurrency, you're going to have capital gains. And these get taxed at what we call preferential rates. So I'll call them pref rates, better rates than the income tax. So it's another level of taxation in our tax code. Now, if you have cyber, let's just talk about that for a minute. If you have cryptocurrency, that's subject to capital gain rates when you use it, when you sell it, and when you use it means buying something. And the preferential rates for capital gains are only if you hold it over 12 months and 1 day. If you hold it over 12 months. So it's 12 months plus 1 day in order to get the preferential rates. Let me say that again. If you're holding crypto or any stock that's subject to being sold and having a gain, that gain will be taxed at better rates than regular tax if you hold it for greater than 12 months, which means 12 months plus 1 day. So if you're dealing in cryptocurrency, you need to report all your transactions, whether they're long-term, 12 months and 1 day, or short-term, less 12 months or less. You need to report all those. When you use it, it's a gain. Let's just do an illustration to make sure, because crypto is on the IRS's big list to find out people who are not reporting their crypto. So you buy the equivalent of $1 in cryptocurrency, we'll call it crypt, and what you do is 2 days later, you go out and you use it, that same $1 to buy $1.25 worth of goods on the internet. You just say you're using it on the internet. You now have a gain. It only cost you $1. You now have a gain of 25 cents. That's got to be reported. And since you did it with 12 months or less, in this case, I gave you like you did it 2 days later, it's short term, subject to regular rates. So the planning opportunity, just for those of you who might be doing cryptocurrency, is here's what you want to do. If you can hold it for 12 months and a day, then you're going to get much better rates. In fact, depending on your income level, the rate may be zero. So planning with cryptocurrency or any capital gain assets makes good sense. All right, so what did we do so far? We covered the formula, income deduction, which would generally be standard deduction. And here you see in the illustration, it would give you a taxable income of zero, and you got no tax to pay. You might ask at that point, why do I have to file a tax return if my tax return looks like this? And that's a good question. So what may be the issue for you, if you're asking that question, would be the following. And let's go take a look at some sort of details and just kind of get a picture of what it is that might cause you to want to file. Okay, so let's just see here. Hold everything. We're almost there. Okay, here we go. So you will, if you earned income, if you had a job, you will have received a W-2 for 2024. And for argument's sake, let's just say this is the only income you had, and it's equal to the standard deduction, 14,600. So your first reaction is, I don't need to file a tax return because you just showed me the formula that the 14,600, assuming no other income, will be reduced by the standard deduction of 14,600. Yes, that's true. And now have taxable income of zero. Yes, that's true. Do I have to file? Technically, no. But if you have a number, any number here, X marks the spot, and here, these are what are known as withholding taxes, taxes that the employer deducted from your paycheck, sent them to the federal government and the state or the state government on behalf of your potential income tax. So by having those taxes withheld, it means that the government has money that has been sent to you in your account, your social security number, that says this is for taxes 2024. And if you wind up having zero tax or a very low tax, it could be that you are entitled to get some of this money or all of the money back as a refund because it was withheld higher than you need. That's legal that the employer does that, perfectly legal and perfectly safe and sound to file a tax return asking for some or all of that money back, depending on what your real tax liability is based on the formula coming up with taxable income. Questions on that would be, this might be a good point to check any questions.
I don't see anything, Sam.
Okay, good. I mean, no problem. Okay. All right. Now, as a resident of the United States, based on what we described before, you should see tax withheld under Social Security here, and that would be correct. So you would see numbers here and here and here and here and probably income tax there. All of that would be correct. And this pays that Social Security tax that we mentioned that as an independent contractor or a gig employee might have to pay on their own. This it's under the W-2, it's paid for you. So life is easy if all you're doing is earning income through an employer. All right, now let's go back to the formula a little bit and just finish the formula up so we have a complete understanding of how that works. And I think we had here the formula where we took our income, we took the deduction that we're allowed, the standard deduction, we get our taxable income. Then there's one last thing, and I just want to mention this because it's applicable not to every student in our school, but every once in a while it's applicable to somebody. Then we have what are known as credits. Credits are certain tax breaks for doing an action that Congress would like you to do. For example, if you owned a home or a building and you put up solar panels, you would get an energy credit. And that energy credit would be able to reduce the tax that you owe. Some credits are refundable, meaning you would get the money even if you don't have any tax due. So these credits come after the taxable income. And just to illustrate like how they work, let's just take a quick example. Suppose we came up with, okay, let's say 24,000 income. So we had taxable income of 10. And just for argument's sake, suppose we had a $1,000 tax that we had to pay. Now, if we have a credit that's refundable, or even any credit, if we have a credit of $1,000 for putting up solar panels, Now our tax is zero. So credits reduce tax dollar for dollar. That's the nice thing about credits. They reduce it dollar for dollar. In the event that our taxable income came up to a point where we had $500 of tax, then the $1,000 of credit would only yield us a zero, and we don't get to use the extra 500 for any reason unless it's considered refundable. So if the 500 was refundable, you would get that back as well. There are only a few credits that are refundable. And I say that for students, they're very rare to have refundable credits for students. So we won't go into too much detail about that. The reason why credits are important to you, why I mention it, is there is one credit that might be available to you if you have tax. So let's illustrate. If you have tax, there's one credit that might be of interest to you, and that is for tuition paid, the education credit. So I'll call it tuition paid. And the famous name for it is the education credits. They may be of interest if you do have a tax that you compute on your return. And then you need to see if your parents are using that education credit. You need to check with them. And then you need to check with an accountant, I suppose, to see whether you're eligible to claim yourself for the education credits. Let's go into that detail for just a little bit, since it's relevant to what we're talking about right this minute. Isn't tax fun and confusing all at the same time? Yes, I'm sorry. It's a very complex code. All right. We're talking about the tuition credit, so let's go into some of the detail, and then we'll come back. We'll come all the way back to the kiddie tax. So I'm going to wrap it up. We started with the kiddie tax. We're going to finish with it. In the meantime, we want to understand how to work with the tuition credit in case that works for you. All right. If you are in college, you may or may not be a dependent of your parents, because if you're in college, chances are they're taking care of your needs, maybe even including tuition, but even not including tuition, they provide a home for you, they provide clothing, they provide food for you when you're home. All that could add up to saying that under the tax code, you're a dependent of your parents. You can be a dependent of your parents up until, but not including, so you have to be less than 24 years of age and in school full time. So less than 24 years of age and in school, which everybody here is, because that's where you're coming from, University of Maryland. So in school, the general rule is at age 19, you're too old to be a dependent. But if you are 19 to 23, those years you can still be a dependent if you're in a accredited or a regional or whatever it is, normal university, community college, normal schools that we associate with being higher education in the United States. So that means that in this case, if we're looking at somebody age, let's say 22, they're in school, they are first and foremost a dependent of their parents, even though you may have room and board here, even though you may be buying clothes, you are first and foremost by default a dependent of your parents, because when you're not in your dorm or not in the apartment off campus, you go home where they take care of you. There is a way to determine whether or not you can be claiming yourself as a dependent, but before we go there, let's explain why. All right, so here, let me get to, okay. So one of the reasons why knowing whether you are your own dependent or not is in order to qualify for the education credit that we spoke about, and the credit is based on tuition paid. It's a percentage of tuition, roughly 20%. And that credit goes up to $2,500, which could save you $2,500 of tax. I think for you, it goes up to 2,000. For your parents, it might go up to 2,500. So one of the things that is going to be a family issue is whether the tuition credit belongs on your parents' tax return or your tax return. In the event that your parents cannot claim the credit because they have too much income, not an unusual scenario, then you want to see whether or not you can take the credit, and that would depend on whether you have any tax computed at all. If you have no tax, the credit won't help you. So let's just say that. If you have tax, then you want to look into this if your parents are not taking it. So if you have tax, parents not taking the credit, then you want to consider whether you can take the credit yourself. And it could be worth up to $2,000, reducing taxation if you have that much in tax after computing your tax rate at the taxable income. So that's why I mentioned this. I'm not going to go into too much more detail about it. I will let you know that there is a great place to find. I'm going to show it on my computer here for a second. So let's, sorry for the, let's see if it's here. Let's see if that's it. Nope. That's my international tax class, but here you go. Same thing. I must have done it earlier. There we go. So this worksheet is helping you determine whether you can claim yourself as a dependent in the event that your parents can't claim you as a dependent. They can't, in the event that the parents cannot use you. I'm sorry. In the event that the parents cannot use the tuition credit on their tax return for tuition paid, then you want to start looking at whether or not you can use it if you have any tax whatsoever. If you do, then being able to use the tuition credit on your tax return would be a really smart thing. And you'll need this worksheet for determining whether or not you can claim yourself as a dependent. It's on irs.gov. Debbie, you can email me after the session and I'll send this along with any slides that you might want as well.
Okay, and we have a question that applies to this.
Okay.
We have a student who says, what happens if you are the sole provider of your house and you are taking care of your parent?
Oh, so that's a flip. In that case, you, depending on their income level, is it depending on their income level? Wow. Yeah, probably depends on their income level. You may be able to take those as a dependent yourself. You may have those two as dependents on your tax, which would reduce your tax even more. So that's something to consider. And they could even be in a nursing home or assisted living center. And if you're paying for that or you're responsible for it in some manner, then you may have that same situation. But certainly if they're living with you, and they don't have a lot of income, they could be dependents of yours.
Thanks, Sam. And we have students, a couple students who have questions about income. Do you want to take those now, or will you be
Let's do
covering?
it. That's a good idea. Let's
Okay,
do it now.
okay, great. First one, are scholarships income?
Oh
And
boy.
what,
Okay. Yes, this is a good idea to do it now. All
okay,
right. So let's hold on a second. Okay. All right. Here we go. This is the pertinent form that you're talking about, assuming it's for 2024. You probably will have gotten one of these. And what it will show is how much tuition was paid to the school and box one. So keep box one in mind. This shows how much tuition was paid. Qualified tuition, which means the actual tuition itself, fees required to go to the school, and sometimes related expenses, which would be, again, requirements to buy certain books. It's not discretionary books, but it's requirements of certain courses might go into that number as well. Then what you want to do is you want to compare that number to box five, which is that question that's been raised, scholarships. What you're doing is you're looking at box five and you're comparing it to box one. In the event that box one is greater than box five, the scholarships are tax-free, no problem, no issue. If the box five number is greater than box one, if the number five is greater than box one, then you may have taxable scholarship income, because it's most likely what's happening is you're getting in your scholarship more money than you need for your tuition. And that more money is covering room and board, which are not subject to the tax credit. They're not subject to a deduction. They are personal expenses. You're getting it for some maybe books, maybe a fellowship to help you live, etc. And that portion, the difference between box five and box one, the amount that box five is greater than box one is most likely a taxable scholarship. There's a few rare exceptions, but and they're very rare indeed. So that's That, I hope that helps answer the question. You definitely want to consult with a tax professional if you have box 5 greater than box 1 to determine how much of that might be taxable.
So, okay, thanks, Sam. And just a few more things about income. What about student loans, stipends, tuition remission?
So,
How
okay,
do
good
those get
question.
classified?
All right. So stipends, tuition remission, fellowships,
Yeah.
these are all neat words. And tuition remission, that's another expression everybody uses. So I'll just write tuition remission over here. You get the idea. These all mean, for tax purposes, these all mean the same thing. They might mean different things to you because of the source from which they're coming from, but they're all the same thing. They're monies given to you to pay for tuition and sometimes more. And that's the key. If you're getting sometimes more, if you're getting for personal expenditures, for room, board, entertainment, movies, you name it, that those are personal items that are not considered to be they're not considered to be non-taxable scholarships, non-taxable stipends, fellowships, or tuition remission, and it would be taxable. So you really need to look at the overall picture. Is somebody helping you with your daily needs of personal items, personal expenditures?
Okay. Um, Earlier you had mentioned the education credit, and a student wants to know how and if they can claim themselves for the education credit.
So you have to be providing more than half of your support, which was that schedule that I was showing you from irs.gov, where it helps you compute that, whether you're providing more than half of your support. And you may be because of the fact that you work and the fact that you might be helping pay for the tuition, et cetera, but you don't have to pay for the tuition. So this is a great question. Your parents could be paying tuition, but you still may qualify based on other facts and circumstances to claim yourself as a dependent, in which case then you can claim the tuition credit on your own, even though the parents are paying the tuition themselves. You get credit for it if you're not a dependent of them and you're your own dependent. You can then claim it. Now you got to make sure they're not claiming it because you can't double dip on this one. Only they can claim for a certain amount of tuition, I suppose, and you could claim for a certain the rest of the tuition, but only up to the $10,000 of total tuition that will qualify for the credit. And I'll say that if you have a situation where the parents are eligible to take the tuition credit, you might want their accountant, their tax preparer to make a determination whether they should take it if they're eligible to take it, meaning if you are a dependent of theirs, they are definitely eligible to take it. And so maybe that's how it should end up. But this is something that you may need to involve your parents on if it's not clear if you are a dependent or not.
So is that tuition credit only applicable to full-time students?
No, you could be half-time and you still would qualify for it. There are two levels of tuition credits. I will just mention them and won't go into a lot of detail due to time factor, but you have what's called the AOTC, the American Opportunity Tax Credit. That covers your first 4 years in college. It's a little bit more of a valuable credit, but after that, you still get credit for what's called the lifetime learning credit, which is for any college credits. Here you have to be in school at least full-time, half a year. And for the lifetime learning credit, it doesn't matter. Any coursework that you take, 3 credits a year or something like that, this credit is available after the first 4 years. And it's valuable. It's not as valuable as the AOTC, but these are the two levels of credit that you would be eligible for. This would be something more that you might be eligible for because you're a grad student or you're taking courses after the first 4 years, you're working, maybe you're going back to school for another degree, whatever. This would be more likely to see in our students sometime in their lifetime because they're lifetime learners. There, that's it. Because you're lifetime learners, you're more likely to use the lifetime learning credit. All right, any other questions?
Well, there are, but you may be getting to this. So we have some questions about where to show a contribution to a Roth IRA and an inquiry about, do we need to report proof of health insurance?
Oh, yes, you will get, let's do the health insurance question first, and then we'll come back and do the Roth IRA.
Okay.
So health insurance, that's a great question. The reason why you want to be aware of how you got your health insurance is because there is a tax, uh, uh, there's taxable refund money. There's money that could be coming due to you if you're buying your health insurance on what's called the marketplace. And if you're buying it on the marketplace, you'll know it because it's pretty, you would know if you're buying it on the marketplace. So if you are doing this, then you're eligible for some assistance to pay for your health insurance. If you are receiving the advanced marketplace subsidy, then you definitely have to report this on your tax return to determine whether or not you got too much. So there's a certain limit, and you're going to need to fill out the applicable form for eligibility on how much you're entitled to for buying health insurance on the marketplace or getting the stipend that's due you, and it's based on your income levels. Now you'll know how to do this, or your tax preparer will know how to do this because you will have received Form 1095A. And that's the form you would give to your tax preparer to help calculate. In the event that you've got health insurance paid for by your parents under their employer plan, or they're paying for health insurance through the school, any private health insurance outside of the marketplace, and none of this would apply to you.
Okay.
Next question was the Roth IRA. So let's just take a look at that and see how that fits into the tax formula. And what we'll do here is we'll look at the actual tax return. I I should do this to scare students to say, okay, I'm going to just go to TerpTax. Forget it. I'm not going to try it on my own. I think this, just looking at this is only page 1. Okay. So, all right. So it really mimics the formula. You're reporting your income, and then you're looking at your deductions. Here's that word, standard deduction. If you can see it, here's your income. There's a standard deduction. In between the income and the standard deduction is where the IRA falls in line, and that will be somewhere, let's see, right around here. Okay, adjustments to income. In this Schedule 1 would be the the regular IRA. Roth IRAs are not deductible. So the Roth IRA, you're never going to see on this page. You'll never see it here. It's not deductible. It doesn't affect the tax formula. A regular IRA, the traditional IRA, up to, in your age bracket, $7,000, if you have earned income of $7,000, a regular IRA is deductible and would show up on this line over here as a reduction of your taxable income, reducing your taxable income. And that's nice. And then there's a question becomes whether you should do a Roth or a regular IRA. There's going to be an article coming out in the Smith, whatever they do here with the Brain Trust, or I just wrote it. It'll be published in a couple of days. Debbie, remind me, I'll send you the link, and you can send it out to all our our wonderful students.
Will do.
All right. And it talks about whether to do a Roth or a regular IRA. But one thing that's in there, which I really want to say now, because it's one of the most important things to my heart, is that if you're earning any income and you can put some of it into an IRA of any kind, do it. The earlier you save, the greater it will work towards your benefit, towards retirement. So it's just that compounding of interest and dividends. Save as much as you can when you're young. And then when you get to be old like me, you have a nice little nest egg to retire on, but you're you can't do anything because your bones and body don't work. Oh, what a life. All right, never mind.
Sam,
Yeah,
questions.
yes.
A student is saying that it sounds like you're talking about reporting earned income from interest, but Their question is about reporting contributions. Is
Um,
that
this is
not
for,
relevant or reported?
for the Roth or the IRA. Is that what we're talking about? Is that the same question?
I'm waiting for the student to, and you can unmute yourself. Oh, they said yes. So I think that's yes, that's about the Roth
Yeah.
IRA.
So what I answered was, what do you do with the contribution? And that's true. That's what I was talking about. The interest and the earnings of IRAs do not get reported at all until you take the money out. So that's the nice thing about these IRA accounts is there's no tax on the earnings until you take the money out.
Okay, that's clear.
All right, good.
Let me go back to health insurance. There are a couple
Okay,
questions. So
okay.
some of the students got their health insurance through the university,
Mm-hmm.
but were they supposed to receive a 1095A from the
No,
university
no,
or,
they would not. They would not.
okay, so where does that form come from? Is that something they fill out or,
This would be something that you would get if you were using the marketplace or if you were not being covered by an employer rather. So
okay,
that form would only be if you have a special circumstances, you're using the marketplace.
okay, so the marketplace, so if you got your health insurance through the university, that is not the marketplace.
Correct, correct.
Got it.
That's a private
Okay,
insurance carrier and you're good to go.
yeah,
You just tell your tax preparer, I have health insurance.
okay.
All right. In the time remaining, I can still take questions, but in the time remaining, I want to go back and finish up how I started because I was calling everybody a kitty tax. Here's the point. All right, let's get to it. Kitty tax is based on these, it applies to not earned income. So if you work for somebody, it doesn't apply to that, but it does apply if you are age 23 or younger and in school here, which most of you are. It applies to, let's get to the, I got so many things in there. Okay. Applies to dependent children who are younger than 19 or between the age of full-time students ages 19 through 23, including 23. It applies to these people, which I think that you got the message. And what it means is that if you have unearned income, so let's get to what unearned income looks like. Unearned income is basically what you call investment income, taxable interest, dividends, capital gains, taxable scholarships, income produced by gifts. There is this. Don't worry about that. That's a little bit advanced. It's the income produced by gifts from grandparents, not the gifts, not the gifts themselves. You're not taxable in gifts, and it's income produced by certain custodial accounts. Again, you can you pretty much ignore that. That's not true. That's that might this be. I do need to cover this one. So hold on to your hats. Let's just get the big picture. You have earned income, which would be subject to tax to you, but the standard of deduction that you get is based on the amount of earned income. So let's go through this very step by step. You'll get the picture, I promise. You have earned income, internships, W-2s, whatever that number is, whatever that number comes out to be for the year, the total, you can take the standard deduction against that up to the 14,600. So if you
Is,
earn, go ahead.
excuse me, is our student loans earned income?
No, I think someone asked that. I forgot to answer that. Loans are not income, not
Okay,
income. I'll give you a little advanced tax class on it. It's not income when you receive the loan. In the event somebody says, you know what, I'm forgiving the loan, you don't have to pay me. Then it's income because now you're wealthier because you don't have to pay the loan back. But loans themselves are not income, just like gifts are not income. Okay, back to the earned income. So what this means is unless you earn greater than 14,600, you probably don't even need to file unless there's been tax withholding. So if you had a W-2 and there's income tax withholding, you should file to see if any of it is refundable to you. It's your money. But this is just showing you that you have to have a fairly decent amount of earned income before you are subject to tax, because the standard deduction is pretty nicely situated in a robustly high number. However, this is not true when it comes to unearned income, which is this category here. And that's the purpose of teaching you about the kiddie tax, because all of this type of income could be taxable to you if it's a certain amount or more. And in brief, before I give you the number, let the drum roll, Bo. But in the meantime, I just want to mention this one here, which is the income produced by custodial accounts. Your parents or relatives may have given you gifts in the past, and they would have gone into custodial accounts because you were not of age. The age in Maryland, I think, is 18. And so they are held in these sort of loosely trust type accounts with your relative's name. Whoever gave you the gift would be on it most likely, and it's under the Gifts to Minors Act. You were a minor when you got it. It earns interest. When you turn 18 or over, the interest earned on it belongs to you, and it's taxable to you under the kiddie tax regime, because that's why it's on this list, could be taxable to you. So you should get, and all of these, what you would get Forms 1099 showing you how much was earned. So you would have these forms, 1099. I'll show you a picture of it in a second. Here's the point. This number, these numbers here, sorry, hold on. There we go. I got it. This unearned income amount, in order to be required to file a tax return, you would have to be over $1,300. So if you have over 1,300 in total, in aggregate of all these different types of unearned income, then you must file. I'm going to summarize this all up in a second. I just want to show one other thing, and then I'm going to summarize the earned income issue and one other thing. So give me a second to find the right form to show you the picture. So far, we saw the 1099-T, 1098-T, I should say. We saw the W-2, which was here. Here's the student loan interest form. If you have paid student loan interest, you'll get a 1098-E, and you can take the deduction of student loan interest paid against your income. So that's good if you paid the interest. If you didn't pay the interest, it'll go to whoever did pay the interest. Then there is a form, then we did the W-2, and then there's a form 1099 NEC for non-employee compensation. That's the gigs, that's the Uber, that's the internships where you were an independent contractor, and it'll tell you how much to report, how much they paid you on your 24 tax return. Summarizing these three topics up, you can have earned income, which would be the W-2 or the 1098 NEC. These are all earned income. You can have unearned income. And if this is less than 1,300, you don't have to file a tax return. If the independent contractor amount is less than 400, you don't have to file a tax return. And if this has withholding taxes on it, the W-2 has withholding taxes, or I should say no withholding taxes, then in these three cases, if this is your picture, then you don't have to file a tax return. So greater than, this should say less than 400. Got to write it like the mathematicians. Less than 400. So if you have no withholding taxes, NEC income less than 400, and unearned income of less than 1,300, you may not have to file a tax return. I'll just have to say here one thing is that if you have earned income greater than 14,600, you still will have to file. So greater than 14,600, you'll have to file. So this is trying to summarize whether or not you need to file a tax return. I would say that in the event that you got any of these things in any amount, file the tax return using TerpTax. It's free. Get it done. get it out of the way. Even if you wind up having zero taxable income, uh, the result is, and this deserves, I think, a little bit of an audience here for a second. Just pay attention with me and bear with me. I'm the deliverer of the news. I'm the messenger of the bad news of what the tax code is like. But so don't blame the messenger. But here's the deal. If you don't think you owe any tax, but you did earn something somewhere, file a tax return. It's what I call a protective filing. Let's go over that again. A protective filing. What it does is it shows what you think you earned, what you think your deductions are, what you think the tax is. It comes out to zero, and maybe under the strict letter of the instructions, you don't have to file it anyway. In the event that you made a mistake, it's going to be your saving grace, saving you from penalty, saving you from any trouble, because you thought about it. It's the concept of no ink, no think. So you put it down on paper, you show what you thought. You can make mistakes. Mistakes are allowable in life, but in this case, it would be a honest mistake by filing the tax return, showing that you thought about it, and here's what you thought you had. So use TerpTax, file it, and you can rest and sleep at night. There is about 9,990 pages that we didn't cover of the Internal Revenue Code left, but time is run out.
All right, Sam, question about that Form 1098T.
Yes,
So is that something that the university sends out?
yes,
Okay. Does it
yes.
apply to all students who are enrolled or only those who paid something? So for example, we have a student, they're a fully funded doctoral student. So the only thing that they've paid to the university is their parking pass, the grad student fee. So how does that work?
Somebody's paying that tuition, so they should still get a 1098T.
Okay. And those have already been sent out, correct?
They have, if you didn't get
Okay.
it, way to check with payroll or the school, the register or whatever it's called, and get a copy.
Do you know if they can get it through Workday?
Don't
I
know.
don't,
Yeah,
yeah, I don't know. Everything is so new that we're all trying to figure out Workday. I would ask the HR person in your department and they
yeah.
should be able to help you. All right, any other questions? And they say, thank you. Thank you, Sam.
Thank you. I always say this as long as you're still here, I'll just say one last thing. And I tell this story more often these days because the tax code has gotten more complex than
Yeah.
ever. And that is during his lifetime, Albert Einstein was known to have said in front of a couple people that the most difficult thing in the world to understand is the income tax. Now, that's Albert Einstein. Okay.
Yikes. Hey, I'm looking at the questions that were submitted upon registration. And someone has two W-2s. They want to know how to file their taxes in that case.
Every W-2 you get, you put down. Best case is really, I'm not trying to sell it because we don't make any money. TerpTaxUMD.org. Go there, just let them do it for free. It'll take less than an hour of your time and you'll be done.
All right, sounds good.
And they're open, again, go to the website. You'll see the hours. They're open Monday through Thursday, 6 to 9 in Van Munching Hall. But you can get appointments asynchronously and we'll accommodate. As I said, look for walk-in clinics after spring break, but go get the appointment and get it over with.
Yeah, don't wait till the last minute. All right, another question. So for a grad student who moved to Maryland last August, their graduate assistantship income in Maryland did not exceed the tax line. So are they subject to Maryland tax?
Probably not, which is a nice thing about Maryland. There's a lot of room before you're subject to tax, but you do need to file. Yeah, Maryland will want that. If there's a W-2 involved, Maryland will want to see that.
Okay. I'm going to take this as the last question if you have a minute, Sam.
Sure.
Okay. It's a little lengthy. I'm going to read this. So I am a tax resident and have been in the US from 2016 to today. I had 2016 to 2018 J1, and then changed in August of 2018 to May 23 F1, and then had OPT from August 2023 to July 24.
Yeah.
And then back to studying on August 2024 to present. So I did my return for 2023, but now I have to do 2024. I worked in DC with OPT and lived in Virginia from January to August, then moved to Maryland in September. I have a house in my country. I didn't file anything before. I heard I could still do the returns until 2018 and the 8843. I'm interested in that too.
Okay.
This is complicated. Should they just come
Yeah.
see you at TerpTax?
Right. You can either email me direct or you can get an appointment with TerpTax. If you email me, I'll just set the appointment up with somebody. But it sounds like this case needs to be seen by the experts at TerpTax, and we definitely can take care of you. The F1 student is one of our sweet spots.
Got it. Sounds good. I will let the students know. All right. Any other questions? We've only got a few folks left in the room. Well, Sam, as always, you're a rock star. I don't know how you hold all this information in your head, and I know it's constantly changing, but I so appreciate being able to send students to you and to TerpTax because I know they're going to get the best of advice and help from you all. So thank you for spending time with us today.
Thank you. I really appreciate the opportunity. I love helping our students. That's why I'm here. And
Yeah.
make me available to any of your questions in the future.
Yeah, I will. Well, it was good to see everybody today. Thanks for joining in. I'm going to send you all a link to a workshop evaluation. I hope you will take 1 minute to fill it out because we really do need your feedback. So have a great week. And as always, let us know how legal aid and TerpTax can help you. Thank you. Bye-bye.
Thanks, Debbie. Thanks to everybody. Take care.
You too, Sam. Talk to you soon.
Bye-bye.
Bye-bye.